morning, everyone. As you can see on the slide, Richard Maitland, Employment Tax Partner in MHA, leading our employment tax team nationally. And I'm going to deliver a short presentation this morning to kick off our tax section, covering a couple of key areas. The first one being the impact from the Chancellor's budget, the autumn statement in November last year, some key employment tax developments around the budget, of course, and then thinking about some imminent changes with the start of the new tax year in April this year. What does that mean for employment tax? And also scanning slightly farther ahead to some future changes as well. So, as mentioned, starting with the impact of the Chancellor's autumn statement, and you will all have heard, of course, the dialogue, the debate in the run-up to the budget around changes to employee benefits, and in particular to pension salary sacrifice. There was an awful lot of chatter. It was headlined reasonably far in advance that some major changes were going to happen to pension salary sacrifice. And they did transpire. There are some major changes, but perhaps not quite timed in the way that we expected. So let's just really sort of think about some fundamentals here. Pension salary sacrifice, what is it and why is it so important? So salary sacrifice is a mechanism that many of your organisations will already have in place, maybe for pensions as well. It is a very common use of salary sacrifice. Employee agrees to forego a proportion of their taxable and nickable gross salary in return for a benefit which is more efficient for tax and national insurance. So that's actually quite a neat, quite a convenient mechanism that employees can use to translate taxable nickable salary into something more efficient and get a very valuable benefit in return. And again, one of the key uses for salary sacrifice traditionally and going forward has been around pension contributions. The tax relief position on pension contributions sort of sits alongside this, so we don't need to go into detail about the tax relief on pensions, annual allowances and lifetime allowances and so on. But the reason why pension contributions are such a good fit with salary sacrifice is because the NIC position, the way that NIC relief works in relation to pension contributions. Employee pension contributions, those made by employees out of net pay, they don't have any relief for national insurance, whereas employer pension contributions, they do attract full NIC relief. So what pension salary sacrifice does, it translates employee contributions into employer contributions and therefore generates NIC savings on the amount sacrificed. So this idea has been around for quite some time now. And again, many of your organisations will have implemented pension salary sacrifice many years ago. But when you implemented it, you would have been looking at, okay, we've got employees making pension contributions, their own employee contributions from net pay. Let's implement salary sacrifice to translate those into employer contributions, additional contributions made by the employer, which then unlock that NIC relief that we mentioned and can therefore generate savings on a before and after basis. And critically, with employer NIC rates up now at 15%, there's even more added incentive for employers to utilise pension salary sacrifice. But what the Chancellor did in her budget in November was to say, in future, that amount of NIC relief is going to be capped at £2,000 per employee per tax year. So at the moment, it's much, almost sort of unlimited within certain, sort of minimum wage parameters and so on. And that's been really attractive for employees and employers to maximise the use of pension salary sacrifice. But it is going to be much more limited going forward. And actually, that timing point that I mentioned, we expected the £2,000 cap to be introduced, but what we perhaps didn't expect was it going to be so far into the future. So starting from April 2029, when that £2,000 cap on the amount of salary that can be sacrificed into pension contributions and still attract NIC relief. Anything over £2,000 will be subject to employer and employee national insurance. But, that's now still, even 3 years ago. And so is there an opportunity actually between now and 2029 to maximise those savings, to actually expand pension salary sacrifice with a view to getting the best out of it before the cap is introduced? And what is also really, really key, of course, is that, the pension salary sacrifice is key not just for tax purposes and for NIC, but it's central to many recruitment and retention programs for employees. So future benefit strategies will have to be reviewed in light of those future changes. And are there any alternatives? Can you rebalance employee contracts and pensions in a way that achieves similar results without using directly salary sacrifice? That's one, I think, to be very mindful of, be very careful around those changes, make sure they are compliant. But I'm sure we'll see a lot more of those alternatives being explored over the next 3 years. For now, other salary sacrifice opportunities are not restricted. So salary sacrifice for bikes to work, for example, or for EV vehicles, they're still in place as they were pre-budget. So again, worth thinking about in terms of your overall benefit strategy. And there were some other sort of minor developments in the budget around employment tax. We saw the withdrawal of the £6 per week tax relief for non-reimbursed home working expenses. So that flat rate of £6, that is going to be withdrawn from the start of the new tax year, so April this year. And also some amendments we saw, actually the flip side of that, in that employers will be able to, again from this April, be able to reimburse your employees for minor benefits like things like eye tests, things like flu vaccines. You'll be able to actually reimburse employees' own costs for those things rather than having to pay for the provider directly as you do currently. So some developments there from the budget, sort of big and small. Also some key imminent changes and actions to be aware of, as I mentioned. There's a key change happening from this April. This is around the use of umbrella companies. Umbrella companies typically employing individuals who then have an agreement with an agency to provide those individuals to end clients. There's going to be the introduction of joint and several liability for PAYE between primarily the umbrella and the agency starting from this April. But if there is no agency and an end client has a direct agreement with an umbrella company, then that joint and several liability for PAYE will actually exist with the end client. So that's a massive change in that umbrella sector. So if your business is an umbrella company or an agency, you will see that impact much more directly, of course. But even if you're an end client that has umbrella company employee individuals in your labour supply chain, you could well see that knock-on effect starting from this April. So do watch out for that. Do consider your labour supply chains and what the impact may be. Something else that we've mentioned on previous FD updates, the payrolling of benefits, that's coming in now from next April. It was originally going to be scheduled for this April, but now it's happening next year. So do think about, over the next 12 months, how you get ready for the mandatory payrolling benefits. That will be a big change. It's obviously already available on a voluntary basis, where you payroll every month 1/12 of employee benefits rather than doing a year-end P11D. That's basically the main difference there in terms of that reporting schedule. So if you're not doing it already, you will have to do it in roughly a year's time. Can you get ahead of the curve? And then just to finish off, I mentioned P11Ds there. Of course, we've got the end of year reporting coming up for P11Ds. They have to be in by the 6th of July following the end of the tax year. And then, of course, you've also got your PSA to agree with HMRC if you need to update it, and also to report that by October. In terms of, well, certainly in terms of paying your PSA, you've got until October, but you'll have to submit calculations perhaps in July or August. So do get ahead of the curve. Do think about those upcoming imminent reporting deadlines. do make sure that your finance teams are liaising with payroll, liaising with HR to make sure you've got the benefits data that you need for that effective and efficient year-end reporting. That was that rapid update on employment tax, and I'm handing over now, Chris, to David, I think.
Yeah, absolutely. Thank you, Richard. Yes, lots to cover there. It sounds like one of a core simplification of removing P11Ds to payrolling benefits that actually creates a lot of complexity for business and such like. So wait to see how that comes through, and hopefully is not as arduous as it could be, etc.